Flexi Cap Fund. What kind of return potential this fund has got? What kind of risk potential this fund has got? Let us evaluate and review. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial decisions so that you can reach your financial goals faster and smarter. Before we start evaluating Kotak Flexi Cap Fund, first let us understand what is this Flexi Cap category is all about. This Flexi Cap category can invest across all market capitalization. They can invest in large cap, they can invest in mid cap, they can invest in small cap. There is no restriction. The fund manager can have higher exposure to large cap, or the fund manager can also have higher exposure to small cap, and he can also change this allocation anytime based on his outlook on different capitalization. This fund is suitable for people who have high risk appetite, because this fund will not only invest in large cap, will also invest in mid and small cap. The general time frame suggested for this category is 5 to 7 years time frame. 7 years and above is a market cycle to capture the entire market cycle and get inflation beating return. You need to stay invested for 7 years or more. The objective of this fund is to generate a long-term capital appreciation. Right? Being a equity-oriented fund, in the short term, there is a risk of generating negative return. That is why this fund focuses on generating long-term capital appreciation. Fine, we have understood what is Flexi Cap category. Now is the time to understand what are all the different framework through which we are going to review this fund. There are 3 segments by which we will review this fund. The first segment is attributes of the fund. Here we will look at the key features of this fund. Then we will analyze the returns from different perspectives. We are not just going to look at what is the past performance. When we look at past performance in isolation, it can misguide. So we are going to analyze past performance with different parameters so that you get better clarity. In the third segment, we will be analyzing the risk potential of this fund. With the different metrics we are going to view, especially bad volatility, not volatility as such, only the bad volatility quotient we are going to measure. That can definitely add value. And finally, what's the general important remarks on this fund? That we will be deciding. In case if you choose to invest in this fund, what are the other things you have to look at? Also, we will discuss at the end. Okay, first we'll move on to the first segment, which is attributes of the fund, Kotak Flexi Cap Fund. The minimum investment in this fund is just 5,000 rupees, and if you are doing an SIP, it is just 500 rupees per month. This fund is there from 2009. So this fund has got a long history of 12 years, which is very good time frame. And the benchmark is Nifty 500 index. It is an open-ended equity fund and has an assets under management to the tune of 35,000 crores. And the expense ratio is 1.60% is the expense ratio. Fund manager is Harsha Upadhyaya. Portfolio turnover ratio of this particular fund is 5.01%. How frequently they churn the portfolio? 5.01% only they churn the portfolio. 49.96% churning ratio, turnover ratio is there for the category. Compared to the category average, this particular fund churns the portfolio less. That means this fund really believes in long-term investing, buy and hold investing. They don't go for momentum investing. They don't go for short-term market outlook based calls. They don't go. Focusing on buy and hold and long-term investing strategies are good attributes of the fund. Right. So portfolio turnover ratio of 5.01%, which is much lesser than the category average, is actually a good for this particular fund. Total number of stocks held by this particular fund is 52 and the category average is 51.19. That means this fund is not over diversified or the fund is not concentrated. The fund is having enough diversification of 52 stocks, which is actually again a good observation on this fund, because over diversification is also not good, concentration is also not good. 62% of the fund is invested in large cap, 25% in mid cap, 2% in small cap. So this fund has exposure to mid cap and small cap also. Being a flexi cap fund, they are allowed to invest that much. Top 10 holdings of this particular fund are ICICI Bank 9.65%, Infosys 6.86%, Reliance Industries 6.75%. They also have exposure to SRF, HDFC Bank, Ultra Tech Cement, L&T, TCS, SBI, Axis Bank. Because this fund has got higher flexibility to move between large, mid, and small, this flexi cap fund, though they have flexibility, this particular flexi cap fund has got higher skew towards large cap, right? This fund is also skewed towards large cap stocks. Top 10 stocks actually weigh 55.55%, right? So though this fund is diversified into 52 stocks, top 10 stocks amounts to 55%. That means the balance 42 stocks has got only 44.5% weightage. So this portfolio concentration can be productive as well as counterproductive. That we have to evaluate based on the result only. Sectoral allocation, the top sectors are financial, technology, and energy. It amounts to 47% allocation. So rest of the sectors amounts to 53%. Again, sector wise also there is a concentration. Concentration can be productive and counterproductive. That we have to evaluate based on the result only. This fund doesn't have an exit load if you are withdrawing after 1 year. If you are withdrawing before 1 year, there is an exit load of 1%. Short-term capital gain, that is if you are withdrawing before 1 year, then you are accountable to pay 15% tax on the gain. Long-term capital gain is if you are withdrawing after 1 year, it is accounted as long-term capital gain. If you are withdrawing after 1 year, long-term capital gain tax is 10%. In the long-term capital gain, up to 1 lakh is exempt. Over and above 1 lakh, you have to pay 10% tax. We have looked at the complete key attributes of this fund. Now is the time to look at the returns. Now is the time to look at the returns. Last 1 year, this fund has delivered 2.89%. Last 3 years, 8.89%. Last 5 years, 9.22%. If we simply focus on past returns, we may not get a clue. That is why we have compared this fund with the respective benchmark. When I have compared this with the respective benchmark, this fund has actually underperformed the respective benchmark in 1 year, 3 year, 5 year, and 7 year. Only in the last 10-year category, this fund has outperformed the index. So being an active fund charging high fees but not able to outperform the index is not a good sign. What is the rank within the category? Except for 10 years, this fund is not placed in top 10. There are other competitor funds or peer funds which are performing better than these funds in the last 7 years. Last 10 years, this fund holds the 6th rank. Again, in the last 10 years, the fund is not among the top 5 performing funds. Rolling return is an important analysis which we do when we are selecting the fund. Because when we are looking at only point-to-point returns, it may be misguiding. That is why we generally take the rolling return. If we focus on the maximum and minimum column, in the last, say, in any 1 year period, if you look at it, the maximum return delivered by this fund is 87%. In another 1 year period, the fund has delivered 30% negative return. That means this fund has a range of 87% positive to 30% negative in 1 year period. But for 3 year period, the range is 31% positive and minus 5%. And 5 year return range is 25% positive, 1% positive. If you look at from 5 year category onwards, it has not delivered negative returns. Similarly, if you are selecting any 10-year period, this fund has delivered more than 8.59%, maximum of 18.37%. So this fund obviously gives a clear indication that if you are staying invested for more than 5 years, it will give you positive return. If you are staying for more than 10 years, this fund has got the potential to give you more than 8.5% return. So after 5 year period, the possibility of giving negative return seems to be very low with this fund. So this is the insight we get from analyzing this fund. If you are staying invested in this fund for a longer time frame, this fund has got the potential to beat the index. Best and worst quarter will tell you what kind of volatility this fund can bring to your portfolio. Do you have enough mindset, enough conviction to stay the course regardless of the ups and downs? In Q2 of 2020, this fund has delivered 23% positive return. In Q1 of 2020, this fund has delivered 27% negative return. So if we look at it, there seems to be a huge volatility in one particular quarter itself. There is huge volatility. So that seems to be a short-term volatility that is happening. So just because it has delivered 23% positive return in one quarter, we can't consider this as a good fund. Because it has delivered 27% negative return, we can't consider it as a poor performing fund. We can't consider. What I'm trying to convey through this slide is what kind of risk this is adding to your portfolio. Though this is a return, here we have to understand what kind of risk it is adding to your portfolio. Do you have enough conviction to stay the course for 7 years plus, even after seeing 27% negative return in one particular quarter? If you are comfortable, then these kind of flexi cap funds you can consider. If someone could have invested 1 lakh before 7 years, the present value would be 2,03,000. If someone could have started an SIP of 10,000 rupees for monthly SIP of 10,000 for 7 years, last 7 years, the present value is 12,10,000. 12,10,000. So both in the lump sum category and monthly SIP category, this fund has delivered definitely a reasonably a good return, inflation beating return. We have analyzed the return from different perspective, different standpoint, given you what kind of return potential this particular fund has got. Now is the time to analyze what is the risk involved in this fund. Before moving to the risk part, we will simply look at what kind of returns the competitive funds have delivered, and we will move on to the risk. Right? Peer group comparison, if you look at it, expense ratio wise, this fund is the lowest in this particular category. That is an advantage in this particular fund. In the actively managed flexi cap category, this fund seems to be one among the lowest expense ratio. But if you look at the kind of performance it has delivered, The last one year, this fund has delivered 2.89% in negative return, whereas Parak Parik has delivered 2.05% positive return. So there are competitors who have outperformed this fund in the last 1 year. Similarly, in the 3-year category also, Parak Parik has delivered 20%. This fund has delivered only 8.89% return. Last 5 year, 9.22%, whereas Parak Parik has delivered 16.35. UTA Flexi Cap 12.61. SBI Focused Equity Fund has delivered 12.85. So that way, this fund is we can't consider it as star performer compared to its competitors. There are other competitive funds which has delivered very good return. Now we can move on to the risk analysis. As an investor, you should not over focus on return and get carried away. You should also focus on risk, because managing the risk is under your control. Managing the return is not under your control. So you have to pay enough attention to the risk potential of any investment option. In that sense, let us analyze the risk involved in this fund in detail. According to the SEBI categorization, this fund falls under very high risk category. This fund is suitable for very aggressive investors who is willing to accept very high risks to maximize potential returns over the long term. Key ratios: standard deviation is high. That means this fund has got a high volatility. Sharpe ratio is 0.36. The insight what you should get is poor risk adjusted return. Sortino ratio is 0.36. That means this fund has got low downside protection. Also, beta of this fund is 0.94, highly correlated with the market. The risk of this particular fund is almost equivalent to the benchmark index. Alpha is minus 3.25% return. Definitely, it is an underperformance. When you are investing in an actively managed fund, you are paying additional fees to generate alpha. In Flexi Cap category, there are funds which has delivered good alpha, but this fund has delivered minus 3.25% negative return. That means this fund has delivered less than the index, which is definitely a negative observation on this fund. Volatility. The general volatility which is measured by the market is on standard deviation or beta. They consider when the market go up by 10%, if a fund goes up by 15%, they consider it as a volatility. Though the market is delivered only 10% return, if a fund delivers 15% return, it is high volatility, but it is good for you because it is giving you 5% additional return. So it is a good volatility. We need not worry about it. But as an investor, where you have to get worried is a fund has delivered a 10% negative return. Sorry, the index has delivered 10% negative return, or the category has delivered 10% negative return, whereas this particular fund has delivered 15% negative return. This is a bad volatility. Correct? So this bad volatility alone we have taken, and based on the bad volatility, we have sorted the funds. Where the bad volatility is very high, it is top quarter. Where the bad volatility is very low, it is bottom quartile. In between, you have got upper middle quartile and lower middle quartile. If a fund is there in the lower middle quartile or bottom quartile, then the bad volatility is very less. But whereas this particular fund is considered in 3-year and 10-year category, this fund is in the upper middle quartile. In the last 5 years, this fund is there in the top quartile. That means this fund has got less downside protection for investors. It is definitely a negative observation on this fund. Another important way we capture the negative volatility or the bad volatility or the overall volatility of this fund is the capture ratio. Upmarket capture ratio, when the market goes up, to what extent they capture the upside of the market. See, market has delivered 10% return, whereas this fund has delivered 12%. That means this fund has captured 120% of the upside. Similarly, when the market has come down by 10%, the market has come down only by 80%. That means this fund has captured only 80% of the downside, which is good. In that sense, if you look at the up market capture ratio across 1 year, 3 year, 5 year, 10 year, this fund has not captured even equivalent to the index. This fund has captured less than the index return when the market went up. When the market went down, also it has delivered, it has captured less in 3 year, 5 year, 10 year category. Whereas in the last 1 year, they have captured 108% of downside. That means when the market went up, this fund has went up less. When the market went down, this fund has went down, fallen down higher. So obviously the net result will be poorer than the index in the last 1 year. And the overall capture ratio should be 1 or more, so that it will be higher than the index. Except for the 10-year category, the overall ratio is less than 1. That means the fund has delivered poor returns compared to the market in 1 year, 3 year, 5 year category. Again, it is a negative observation on this fund. As of now, the major chunk of the assets are in large cap stocks. However, they can change the allocation anytime to mid cap and small cap based on their outlook. Because this fund is focusing on large cap at this point in time, maybe a stable ride, but definitely the road is very bumpy in the stock market. Because it is an equity oriented fund, this fund has got a potential to deliver inflation beating return in the long run. If mid caps and small caps outperform in the market compared to large cap, because this fund has got higher exposure to large cap, that point in time, this fund may underperform the particular index. And there are some important things which you have to keep in mind before investing in these kind of funds. Because this fund has got a higher volatility, do you have enough courage and conviction to stay the course for entire 7 years plus? That you have to look at it. Based on your financial plan, what you have to actually check up is whether this fund will help you meet your financial goal and meet the respective risk, like a tolerance of yours. You have to sit with your financial planner and understand. This fund has not outperformed the index recently. Also, there are other better performing flexi cap funds which has outperformed this fund. As an investor, before investing in these kind of funds, you have to look at what is the overlap ratio. What is the portfolio of this fund? What are all the existing schemes you have got? What are all the existing direct stocks you have got? You have to check up by adding this fund. Like, are you bringing new stocks or new securities, or you are just overlapping the existing portfolio? If there is a less overlap, it is better. If there are higher overlap, do we have to invest? Again, check with your financial planner before investing. Hope this video has given you a 360-degree perspective on this particular Kotak Flexi Cap Fund. If you have any follow-up questions, feel free to book a free appointment with our certified financial planners. They can clarify any questions on this fund or other investment options or anything related to achieving your financial goals. To book a free appointment, the registration link is given below this video in the description box. We regularly organize insightful investment webinars with eminent investment experts. They discuss and reveal long-term investment strategies to create wealth. If you want to participate in our next upcoming webinar for free, again, I have given you one more link below this video. Just leave your name and email ID. Your seat for the next upcoming webinar will be reserved. Hope you like this video. I'll again meet you in yet another useful video. Thank you. Bye-bye.